topic of the day is today's tax landscape, risks, opportunities, and planning. And I think it's a very interesting topic, especially at this time of the year. So without further ado, Mr. Jeff Neumeister.
Thank you very much, Joan. As noted, I am a faculty member here at Woodbury as well. I've been in the CPA world for now, sadly enough, 2.5 decades. We provide all kinds of accounting and CPA guidance, including taxes. But also specialize in some areas like cryptocurrency and forensic accounting, business valuations, and more. Given the time of year, I figured for my thought leader webinar, it would make timely sense to talk about taxes, right? Everyone is probably dealing with the tax documents rolling in right around now, 1099s, W-2s, all that good stuff, and the upcoming painful amounts that are going to be owed in the next, really 2.5 weeks to, a month and a half. But hopefully everyone here has a few takeaways, maybe learn something about tax, especially maybe some advantages of tax planning, thinking strategically. If not, you know that I am more than happy to answer some more tailored questions at the end of this, or separately. And I'll relay in the chat box my contact information later. So, quick, just kind of overview. Take note, a little disclaimer up top. Again, everything here is just kind of going to be very high level. It's not geared towards any one person's tax situation. Know that a lot of times the answer for things is going to be it depends. Although we'd like to see just kind of hard drawn lines about what to do, what not to do, note that everyone's circumstances could be a little nuanced. So just keep that in the back of your mind that there could be something about your set of circumstances for which some of the information here may not apply, even if it seems like it does. So as a caution, always confer with a tax advisor or do your own due diligence and figure out how these things will apply to you or could apply to you. I'll give a little bit of background on the current tax environment, some big changes, courtesy of the One Big Beautiful Bill Act, silly name, some tax risks and compliance, things to avoid the IRS scrutiny if possible. Some common mistakes that are made, looking at kind of from the business owner perspective. Okay. Some things you could do to be proactive as an individual, some things you could do to be proactive as a business, a few updates in the estate planning arena, and some takeaways. So, be a lot of information thrown out here. I'm going to talk through some specific things. Okay? But the rest of it is there, just kind of for your own edification. Over the recent years, obviously enough, just like any other enterprise, the IRS and uh, its state equivalents have been investing in their systems, in terms of technological improvements, their training, um, early indications of leveraging AI via embedded versions of AI, whether it's Copilot or other things, but also into what they'll be doing down the road. So obviously AI, and thank you again, Joan, for your session on AI in the last series. But it is going to play a role in how the IRS and other taxing authorities are able to facilitate review of tax returns. Right? So it's only a matter of time that they become even more streamlined. So the good news is maybe our tax dollars will be used a little bit more efficiently, right? And be a little bit more cost effective. The bad news in the coming years is that will increase the ability to scrutinize tax returns and audit a little bit quicker, sending out those love letters to owners, business owners, and individuals. Now, this is still early, so probably not going to see those implications just yet. Not going to feel them quite just yet. And there's also a couple other things happening politically and uh, just in our overall what's going on with the country and the government that's working against these improvements by the IRS and their state counterparts. Things like the government being shut down. Obviously, that puts them a little bit behind on things. So, for example, right now, in the middle of tax season, because we are well into the 2025 tax season, keep in mind, so it's 2026. We say 2025 because we're dealing with 2025 tax returns right now, right? With the government shutdown, that put them behind a bit. So when tax practitioners like myself pick up the phone to call them about tax notices our clients receive or other things, they're not as quick to respond. We send in a response package to a letter. They're not as quick to get to it, right? Because again, they're a little behind on things. And also some of the changes in their budget over the recent years and the individuals that have been let go of from the government. That's also kind of put them a little bit behind on things, right? So, some ways they're a little bit behind, but then these investments in technology and pretty soon AI, maybe they kind of wash each other out. Right? But as of today, on the right-hand side, I have a little diagram there of audit rates by structure. And it's broken down by entity type. So this is anyone that's running a business. Sole proprietors, right? So you go out there, open up a lemonade stand at the end of the street. You didn't file anything with the state. You just started conducting business. An average of 2 to 3%. S corps, half of 1%. Partnerships, less than half of 1%. Most C corps, less than 1% if they're grossing less than $10 million. Now, larger corporations, 22.6%, right? But most businesses out there are small to mid-size, right? Now, for sole proprietors file a Schedule C, which is part of your personal tax return, right? So it's a separate form. It's part of the 1040. If there's material profit being made and or revenues, know that it could be up to 6 times higher more of being audited than if it's a S corp. So keep that in mind. This is another kind of potential strategic play. The advantages of having a sole proprietorship is it costs less to set up. Right? Again, you just walk outside and say, "Hey, I'm in business." Right? Versus setting up an S corp or something else. They to file something with state. Now you have an extra tax return. You have extra compliance to deal with. All right, and there's cost with these different things, but the risk of an audit can be substantially lower. So just something to kind of weigh, and weighing the pros and cons of what kind of business to set up. And also take note of the reality of why the IRS audits. Right? Remember, they're look at them almost as like the key profit center of the government. Right? Most governmental agencies just lose money. Right? The IRS is the number one that generates revenue for the government. Right? And it's largely because they're the ones enforcing the collection of taxes, right? And there's a perpetual variance between what's owed to the government technically and what's actually being reported and paid, right? If everyone properly reported their taxes and properly paid what was actually owed, that's gonna be billions and billions and billions of dollars of additional revenue the government would have, arguably substantially more than that, tens of billions, maybe hundreds of billions. It's a big number. And that's not to say individuals, everyone that is underpaying is doing so intentionally. Sometimes there's some naivety of what to report and how to report, and it's just completely innocent. Like someone had no idea that they had revenue from some platform or from some side gig, and they just completely forgot about it. Right? Very innocent. Versus on the other end of the spectrum, just outright evasion of taxes, right? Hiding things, not disclosing things. The last point on here I want to mention is focus tends to be when it comes to audits, aside from Schedule C business owners, it'd be high income earners, businesses that are cash intensive, right? Cryptocurrency, and anyone with foreign-based income, right? Anyone that kind of checks one or more than one of those kind of categories, just know that there's additional audit risk. Some major tax law changes. Now this again emanates from the One Big Beautiful Bill that was signed into law last year in July, with much of it taking into account for 2025 through 2028. Not going to go through all these, but a couple of them. One of them, no tax on tips. Individuals could deduct up to $25,000 of qualified tips. When it says, when I mentioned phase out, that means that somebody, for example, someone that files single and they make more than $150,000, right? They're not going to be able to take that full deduction, right? The more money you make, the less advantage you have with certain deductions to the point where you may not be able to enjoy them at all, right? The goal of the deduction so that it benefits folks that are maybe lower income earners or middle income earners. Now, things like these new deductions, they sound great on the surface. You have to keep in mind there's caveats involved. There's there's certain thresholds to be mindful of, and there's certain reporting requirements that must be taken into account. And there's almost always restrictions on things. So, for example, with the tax one, I mean the tip one, uh, in order for that to be deducted, the individuals must be reporting all of their tips. Now, anyone that's worked in a business and wherein tips are a primary or major component of compensation, how often are the tips reported 100% of the time to the government? Don't have to call yourselves out, right? But I mean that rhetorically. It is not uncommon for tips not to be 100% reported. That's just the reality of those industries. So to qualify, individuals have to report all their tips. Right? So if someone is not reporting half their tips and then they try to claim this deduction on top of it, that could be very problematic, especially if they happen to be examined or audited. Right? Also know that there's restrictions on what industries for which that is even eligible for. So if it's in a business where revenue or tips are custom, common, again, think kind of like restaurants and bars and such, then okay. If it's in a space that is generally not tipped, right, then it wouldn't qualify, right? And now we know in today's world, at least in the US, you go to almost any business and the point of sale system is, would you like to offer a tip? You could be buying clothing, almost anything, they ask for tips. Um, Same kind of restrictions can apply to the no tax and overtime. Just be mindful that it doesn't apply to everyone. There are certain reporting requirements associated with it. Dropping down to the bottom, know that there's increased standard deductions all around. A big one here I want to focus on is the SALT cap. So when anyone files their personal tax return, you can either take the standard deduction, which in this example, or let's say if they're single, it's $15,750 for 2025. Marital filing jointly, it's double that number. Or you could itemize your deductions on Schedule A. Itemized deductions are where you list out specific deductible items, such as mortgage interest, if you're a homeowner, certain medical bills, if they're above a certain threshold, charitable donations, and things like state and local taxes, or SALT, we call it. Now, in 2017, the Trump tax law changes put a limit on how much SALT could be deducted by itemized individuals. itemized returns, and that was $10,000. And that was huge. The reason is because in states where property taxes and state taxes run high, like California, a lot of people hit that $10,000 cap. Right? How many houses out there, especially in the LA area, where the property taxes alone are more than $10,000? A lot, most, right? Especially in LA and San Francisco, like a lot of different parts of California. So anything over that amount, the deduction is just gone. It's gone. Right? So let's say someone's itemized deductions. Let's say their SALT deductions, hypothetically, are $50,000 and they were capped at $10,000. Right? That's $40,000 of lost deductions. Right? To put that in the context, let's say just presume that their tax rate is about a third of that, roughly, right? Then they're looking at, over $12,000 of lost cash. $12,000, $1,000 a month just for taxes, right? That's a big number. With the one big beautiful bill that raised the cap to $40,000. So now a lot more individuals will be able to enjoy more of that deduction, but there's still that limitation of $40,000, right? Which, some folks, especially high net income earners, certain business owners could easily surpass. There is a workaround to that cap called pass through elective tax. It's something that states like California and many others followed suit. I won't go into that, but just know that if you if you do own a pass-through business like an LLC, a partnership, an S corp, and you are concerned about being limited by the SALT cap, know that there's a way to use your business to get around that limitation, right? I'll leave it at that. That would be a separate discussion, but just be mindful of that opportunity. Some other updates on the right-hand side you could take note of, and I'm happy to share this, my deck with anyone that wishes. Tax risk and compliance. Now, what triggers an audit? Okay. First and foremost, I would say, although it's the second one I listed, but I think it's the number one issue, is mismatching. You receive a 1099 from somebody you provides independent contractor services for. And they said, hey, I paid you $10,000. If on your personal tax return, you don't report that $10,000 or you report a number that's less than that, that's going to trigger an instant mismatch, right? Because the IRS gets a copy of what that person or company is reporting to you. They're saying, hey, government, I gave this person $10,000. So that person on their return better also report the same $10,000. Automatic mismatches like that will just trigger notices automatically, right? So just plan to receive a notice if that happens. And again, accidents do happen, and that's okay. So if a notice comes asking for clarification, respond accordingly. If you need to amend your tax return, do so. A couple other ways that the IRS will select a return for a love letter is their diff system. So this is a system that compares your returns with prior returns, compares it with other individuals in similar occupations, other individuals in similar jurisdictions, right? Because think about it, they have a large wealth of data from taxpayers throughout the country for decades and decades and decades across all industries, all demographics, all educational levels. They have all this data. And so having all this data allows them to kind of identify certain things that are normal within normal ranges and certain things that seem odd, right? So if you are working in a particular occupation in a particular part of the country, and what you're reporting is statistically significantly different than what others in the same set of tax circumstances, that could trigger a flag called a yellow flag, right? And then it could escalate eventually into a notice or a full-blown audit. They also will make a concerted effort to focus on individuals, as I mentioned before, that are doing things in cryptocurrency, cash-intensive businesses, or higher income individuals. Right. Here's a couple examples of where the DIF score could come into play. Right, number one on the right-hand side, disproportionately large deductions. And say you're running a business and the industry average for whatever your business is 35 to 45% of deductions, right? Of business deductions, and you're claiming 70%, that looks odd, right? It's double or nearly double what everyone else is deducting. So that will draw their scrutiny, right? It could result in a manual review. Again, it could result also in a notice or something else. Uh, Reporting round numbers. How often is it, if you, again, think about, and you're running a business, doesn't matter what kind, an S Corp, a sole proprietorship, a C Corp, if over the course of the year you go to Starbucks, you go to Granville, you're eating out, you're paying for insurance, you're paying for car payments, paying for subscriptions, whatever it is that's appropriate to deduct for your business. And at the end of the year, the amount of deductions for a certain expense item is exactly a round number. Not that it doesn't happen, but that is pretty rare. And sadly enough, I've seen more than my fair share of returns from former clients or returns prepared by others, where you go through what they're deducting for their business, and it's $10,000 for insurance, $15,000 for meals, $4,000 for travel. Just making up numbers, right? The likelihood of all these things to be round numbers is, you have better odds winning the lottery. Okay. Uh, Now, what I'm promoting is to report accurate numbers, not to say, hey, if you're going to make up numbers, make sure they look odd, right? And not round. That's not what I'm saying. Just report the actual numbers. Because even if they end up being round numbers, if that's truly what happened and that's truly what the invoices, receipts, and your other documentation supports, then so be it. Audits can sound scary, but they're actually not that bad and they're easy to get rid of if you have the support for it to make it go away. Cash intensive businesses, it's very common, sadly, for not all the income to be reported. This kind of goes hand in hand with individuals or employees working in tip focused businesses. Again, how often are tips 100% reported? Cryptocurrency transactions. So as of 2025, there's a new tax document. It's actually the first tax document focused just on digital assets, like cryptocurrency, that went into effect. And it's a 1099-DA, standing for digital asset. These documents, they start going out January from places like Coinbase and Binance and other crypto exchanges and their platforms out there. And the goal of them is to report to the individuals and the government how much the person received from sale of digital assets. Right? Anyone that reports on their tax return amounts that don't match those 1099s, then that could automatically trigger a notice. So for 2025, those tax documents, 1099 DAs, are only reporting proceeds. So in other words, how much someone earned from selling digital assets or cryptocurrency. Right? Starting this year, 2026, they'll also include the basis. Right? So the basis is how much someone originally bought a cryptocurrency for. Right? So let's say they sold it for coins worth $10,000 and their basis was 5,000. Both numbers will be reported on the form starting this year, which means I'm talking about January 2027 when the 2026 forms go out. And again, both numbers will need to match what goes into the return. Skipping ahead a little bit, some common mistakes business owners make, um, using the wrong forms, right? If it's an S corp, it needs to file 1120S, not 1120. If it's a partnership, it needs to file a 1065, not filed on someone's Schedule C. And those kind of just high level errors can, automatically result in a return not being accepted, could trigger penalties, and obviously can draw some additional scrutiny. Filing late and or paying late, right? So filing late is pretty straightforward. Personal tax returns due April 15th, right? Unless it falls on a holiday or weekend, then it's the next business day. Right? Paying late, there is no extension for that. And this is where there's, I think, a huge misconception that still happens pretty often. The perception that when someone extends their tax return, that it also extends the time to pay their taxes. For a personal tax return, again, due April 15th, you have the right and the ability to seek an extension to file the return as late as October 15th. That does not mean that whatever's owed can wait to be paid till October 15th. It's still due by April 15th. Right? So again, if you extend a tax return, business or personal, that only buys additional time to file the return, not to pay the taxes that are actually owed. Those are still due by their original due date. The penalties for failing to file on time are pretty stiff, 5% per month. So let's say someone owes $100,000 and they don't file their return on time. That means all of a sudden that next month, that next day after the deadline, now they owe $105,000 plus interest that will start accruing, right? And they'll keep stacking up those penalties and interest. Another very common mistake, especially with new businesses and smaller businesses, is commingling business and personal items, right? So, for example, using a personal credit card or a personal bank account for business and personal things, right? As a business owner, it is your obligation and best practice to keep those items segregated. You have business transactions flow through a business account and personal transactions through a personal account. Right? Yes, business owners will sometimes maybe pay a personal bill out of the business account, right? And if they're the sole owner, no employees, no shareholders or anything else. Again, very, very common, not best practice, but pretty common. But that will have to be accounted for properly. And that's where it's important, it's kind of skipping to number five here, where clean bookkeeping is going to be important, right? One, to demonstrate to the government, if subjected to an audit, that everything is accounted for correctly, but also that there is an accounting of where things are at any point in time, right? And it's a lot easier to maintain books on a real-time basis for your business than just doing stuff and all of a sudden after filing taxes, after being subjected to the audit, having to backpedal and try to figure out what went where and how the numbers were compiled. Um, Estimated tax payments. Know that if you are self-employed and that's a key source of income, you should be making estimated tax payments each quarter. Um, the reason for that is the government wants their cut over time, right? When we are employed and we receive a W-2 and paycheck, right? We see all those little wonderful deductions on those pay stubs, that take what we thought we were making down to what reality looks like. But those things are being withheld by the employer and sent remitted to the government on our behalf, whether we like it or not, right? But at least the government is being paid throughout the course of the year. If you're self-employed, who's doing that? Oftentimes, unless you put yourself on payroll, no one is because you are the employer, right? And the government doesn't really like that. They don't want to wait until a year after the fact to get their cut for, say, 2025. And so this is where the requirement comes in of making estimated quarterly tax payments. The idea being that you pay the government a proportion of what is going to be owed for the year throughout the course of the year, rather than it being at the very end of the year. Not doing that can elevate audit risk. One more comment on the bookkeeping matter. And this doesn't just apply for taxes, but when you have a business, not having clean bookkeeping records, reconciled bank accounts, transactions classified and stuff, not only does it make it more difficult and costly to file correct tax returns, it also makes it more difficult to withstand the scrutiny of an audit. Auditors don't like seeing commingling, especially commingling with messy books, right? That just begs for them to investigate further and deeper. Right? Poor bookkeeping also is a key reason or or contributing factor to things like fraud and embezzlement, contractual disputes. As I mentioned at the beginning, and those that don't know me, most of my background has been in forensic accounting and expert witnessing, going to court and testifying on matters that often may involve contractual disputes, damage claims, fraud investigations, and whatnot. And easily over the hundreds of investigations I've been part of over the years, I'd say probably a good half of them emanated or were allowed to perpetuate because of poor or no bookkeeping. Okay. So bookkeeping, it serves a lot of purposes, as well as for a business owner, it provides information so you can make financially informed decisions. Some tax planning opportunities for individuals. Um, Thinking ahead. So, you mind, tax planning is looking forward, right? Versus tax compliance, like filing a tax return, is really just taking what already happened and reporting on it. There's really not much that could be done on what already happened in the past. The ship sailed, right? There's not much that could be done, right? But with tax planning, we're looking ahead. We're thinking strategically. Right? So let me give an example. If you anticipate being in a higher tax bracket next year, then it might make more sense to not take certain deductions this year, if possible, and defer them to next year because the benefit will be higher. Right? Let's say your tax bracket, you're paying 20% now, but the next year, because something's going to change fundamentally in terms of your earning capacity, your revenue streams, maybe a new business startup, whatever it is, and also you're effectively paying 30% next year. Taking a deduction this year will save you $2. Saving it for next year will save you $3. Right? Again, doesn't seem like much, but when you add lots of commas and zeros to things, that kind of strategy or that line of thinking can add up pretty quick. Right? Another couple examples with, let's say, capital gains. Right? So, anytime you buy and sell a stock or cryptocurrency, anything of that son, an investable asset, if you held it for less than a year, right, it's going to be deemed for short-term capital gains. Short-term capital gains really don't have any sort of beneficial treatment because they're taxed at ordinary income tax rates. That's the tax rates that we are paid with via paychecks, with other self-employment income, and other types of activities. If we hold these assets for a year or more, they're at much more favorable rates, as low as 0% and capping off at 20%. 0% to 20% is a lot lower than 20 or so percent to almost 40%. It's a big difference. So keep that in mind if engaging in any sort of trading. Again, it could be stocks, bonds, cryptocurrency. If holding on to something for another few days, few weeks, maybe a few months could save you half the tax you would have to pay, then it might be more sense to hold on to a position longer than anticipated, right? But again, that kind of has to be balanced out with the opportunities, especially if you're kind of day trading realm. Now some business strategies. Again, then this doesn't apply to any particular business structure. So again, sole proprietor, C corp, S corp, partnership, all of these can benefit from some of these strategies. Uh, Section 179 expensing. So this has to do when buying equipment. So this could be large machinery, large vehicles, computer centers, all any sort of tangible equipment. Right? It could deduct up to 2.5 million, right, on the front end. Now, why is that significant? Because normally when you buy something, a fixed asset like equipment or a vehicle or something else tangible, you don't get a deduction for the full thing on the tax perspective right away. Usually you get to deduct a portion of it over the life of whatever the equipment is. Let's say 5 years. So let's say you buy a piece of equipment, it's worth $100,000 and its life is 5 years, right? The estimated useful life for equipment. Right? So that means you'd be able to deduct 20,000 each year over the course of 5 years. The nice thing with Section 179 and bonus depreciation is that you could, in certain circumstances, get all this deduction right up front, right? So that means you could get 100% of your deduction, that whole $100,000 today or this year versus having to wait 5 years before you get to enjoy the deduction. Now some estate planning updates. Before I talk about some of the items on here, keep in mind the benefits of an estate plan. Again, I'm not an attorney. I'm definitely not an estate planning attorney, right? It's more than just for tax purposes. Okay? Estate planning is a way to plan for ways to protect assets. It's a way to protect or minimize taxes. And it's a way to avoid things like probate, right? And California is a probate state, by the way, right? Um, if you're not aware, probate is kind of the process of going through the court, the courts, and how whatever we have in terms of valuables and um, insurance policies and assets, real estate, vehicles, whatever, going through the courts, facilitating that process of distributing it to beneficiaries. Now, if someone's net worth or all of their net assets is, 5 grand, $10,000, that's not really an issue, right? There has to be a certain amount. But for a lot of folks, it doesn't take too long to have enough assets that exceed the threshold that mandates probate in states like California. And think about it. If you own a home, even if it's not paid off, you have some vehicles, maybe a little jewelry, some life insurance policies, like all these things, they can add up pretty quick, resulting in something that could trigger probate. And probate could be time intensive, not necessarily cheap, and can be, less than desirable for our beneficiaries, our family members, right? They have to go undergo that process. So having an estate plan, and a trust in place is one way to avoid that altogether, right? Even if the value of what we have or what might be passed on exceeds that probate threshold, right? So again, just another reason to consider having that in place, whether or not there's children involved, right? Um, from my understanding, in the LA area, you could get a decent, pretty decent state and trust kind of family uh, plan set up for a few $1,000s, right? And it's not something that has to be done every single year, and something that I definitely advise all of my business owner clients to do, or at least consider again whether or not they have kids. Um, Now, there's some other benefits that come with it, but it's not going to affect most of us, right? So one of them is, for example, the exemption, the lifetime exemption. Right? So there's lots of different types of taxes, right, we might be succumb to during our lifetime, or our family members could be subjected to. All right, there's income taxes for all aware with. There's self-employment or payroll taxes. Those are some of the things we see on our paychecks, right? FICA, Medicare, Social Security, those things. And there's estate taxes, which can be pretty significant, right? And it could be half of the value of whatever makes up our estate, right? Again, all of the aggregate of our policies and our tangible goods and real estate and everything else that we accumulate over a lifetime. For individuals starting this year, the exemption is about 15 million. Right? For married couples, just double that number. Now, yes, that is a big number. So, how many individuals will have an estate that will surpass that number? I hope I do. I don't know if that'll necessarily happen, right? Again, it's a big number, right? But it can happen pretty quickly for business owners, especially if you're scaling something that might become something really significant down the line. And having an estate plan in place provides some opportunities so to avoid these estate taxes entirely or significantly altogether, right? Let me give you an example. I had a client that started by, I think it was by the grandfather, started this business, and it was a pretty small enterprise at first, less than $1 million of gross revenue. And over the years, they started growing. And they're in the LA area, and it grew to be around a 18 to $20 million business. Again, pretty decent size of top line revenue. But they foresaw that this is something that's going to continue to scale pretty significantly. All right. It would not be um, unrealistic for that business to grow to be $100 million business or more. Right. So they engaged estate planning attorneys, right? And they put together a plan. It's called an IDGIT, an intentionally deficient grantor trust. Right. And what that did is allow them to essentially kind of freeze the value of the business when it was about 20 million, addressed the tax consequences at a frozen point in time for the beneficiaries. I'm oversimplifying this, by the way. It's very complicated, right? And that's why the estate plan attorneys, they get a pretty penny for this work. And then transfer these assets or set up the transfer to the beneficiaries in a way that will lock in this value. So what that means is as they go from $20 million to a $100 million business, regardless of what the lifetime exemption is, right? The state won't be taxed, right? So I don't remember if the grandfather was married still or not, but let's just say he was married, finding single, right? Um, and so that means that $80 million or at least $80 million is a state tax free. And just to keep the math really simple, let's say the state taxes are about between federal and state is 50%. So 50% of $80 million, that's a $40 million tax savings. Not insignificant. So to kind of put it in context, I don't remember what they paid the estate planning attorneys, but I know it's six figures. It was a bargain to say the least. Yeah. I don't know how big the business got to, but I know when I last worked with a client, they're, north of 60, 70 million, right, in terms of valuation. So some things to keep in mind. And there's some other things to keep in mind with the estate planning. Know that when you gift somebody something, that depending on how much you gift to them and what you're gifting to them, it could trigger a gift tax return, right? So if you give somebody, a friend, a colleague, $100,000, you win the lottery for 10 million and you want to show your appreciation for them helping you out back in the day, whatever, right? And you gift them something, very nice to do. But keep in mind, that could trigger a gift tax return that you have to file, right? There's not necessarily a tax consequence for it, right? If you're still underneath your lifetime exemption of 15 million, right? But that's a reporting requirement. Something to just keep in mind. Some year-end tax planning things. Keep in mind of what's happening from one year to the next. If you anticipate a significant change in your income streams, a change in job, a change in roles, a change in what your exposure might be, Perhaps you're about to come into some money. Let's say you're an early investor in some startup, right? Or if you work for a business and they provide you restricted stock units as an incentive early on, and then all of a sudden they go public, and what they gave to you vest, and something that was worth virtually nothing or very little at the beginning is now worth, $1 million. These things happen. Be mindful of what you anticipate to happen in the coming months and years to get ahead of them. What I see happen most of the time is something happens that has a significant tax consequence or could have a significant tax consequence. And then a client or taxpayer starts to look at, okay, well, I understand my tax bill is this. What can we do to minimize that? And sadly enough, most of the time it's nothing. That ship sailed, right? In order to implement a strategy that could have saved a lot on taxes, we would have needed to have a discussion before that taxable event occurred. All right. So again, if something significant might be coming up in the pipeline, right? Whether you're vesting in stocks, inheriting something, a change in income status, whatever it is, it's good to get out ahead of things and not wait until the tax bill, until your tax preparer is giving you a tax return and then asking what could be done to save on the tax. Again, most of the time it's too late, right? You need to do things before the event happens, or at least before the end of the year. All right, because after December 31st, there's usually very little that could be done other than, contributing to retirement plans and that kind of stuff. One last one I'll mention here is on harvesting tax losses. So if you are sitting on a lot of investments that are currently underwater, in other words, the value you bought them for is a lot more than what they're worth today, then you're sitting on unrealized losses. To leverage those losses, you have to sell those positions, or trade for something else. Now, for normal stocks and whatnot, investments, if you sell a position and then within 30 days get into the exact same security or something that's substantially similar, and your whole point of doing that sale was just to harvest the loss, that violates the wash sale rule, right? And any tax savings is not going to happen, right? The IRS will just be like, well, no, that's too bad. You sold your, say, Tesla stock, and then you bought into the Tesla stock a week later, right, after a change in the market, right? Because you still want to hold the stock, but you just want to take advantage of your losses today. You won't be able to. With digital assets or cryptocurrency, however, that wash sale rule currently does not apply. Right? You can sell whatever coins you have at the end of the year, and January 1st, or the next day or week later, wherever, buy the exact same coin, and you could take advantage of those losses. Now, that wash sale rule, I believe, will pretty soon, it could be this year or in the next few years, be applied to digital assets well, right? So just something to kind of keep in mind as another kind of year-end planning strategy. So a couple takeaways. Keep in mind that tax filing and tax planning are two very different things, right? Tax filing is dealing with the past. It's dealing with what already transpired and reporting it to the government. Very little can be done about that, right? Tax planning is getting ahead before things happen, before there's taxable events, and being more strategic, right? And coming up with ways that could minimize additional tax, right? And there's still opportunity to do things. For business owners, be mindful of some of the things that could yield some savings, like 179 and bonus depreciation. Think about how a business structure might limit or enhance tax saving strategies or opportunities. Be mindful of estimated quarterly tax payments. For individuals, especially if you own a business, sole proprietorship or anything else, know that how that will flow into your personal taxes. Think about contributing to 529 plans, your retirement plans, 401ks, deferring where and when you can. Right? And if anyone's working professionally in the space as a tax preparer or other type of advisor, staying on top of these changes, like the one big beautiful bill, and how all these things kind of interface with one another. There really is no one size fits all for this kind of stuff, even though I believe that's where a lot of the focus tends to be. Um, if you get advice from a tax preparer that's pretty sounds pretty straightforward, but they're not taking into account other specific things about your tax circumstances, know that something might be missed, right? Tax planning, more so than tax filing, can be very, very personal. And there again, there's no one size fits all sort of thing, right? So what works for your buddy that has a similar business may not apply to you at all. Right? Let's keep that stuff in mind. And with that, I'll pause a few moments if you guys have any questions.